Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Buy the same Tokyo condo in Japan, and one buyer puts down 0 yen. Another puts down 14,748,000 yen. Same price, same building. The only difference is their residency status. Here's how Japan's mortgage system actually sorts foreign buyers. First, a quick myth check. Japan places no restriction on foreigners owning property, at any residency status. The real barrier was never ownership, it's financing. Japanese lenders sort buyers into 3 tiers, and each one gets a completely different deal: permanent residents, non-permanent foreign residents, and non-residents living abroad. Tier 1, permanent residents, and foreign nationals married to a Japanese national. With a strong income profile, this group can access financing up to 100% of the purchase price, meaning a 0 yen down payment is realistic. Tier 2, foreign residents on a work visa or other long-term status, without permanent residency. Major banks like MUFG, Mizuho, and Resona generally won't lend to this group at all. But a handful of banks built products specifically for them. SMBC Prestia is the best known: no permanent residency required, no Japanese guarantor needed, English language support, and a minimum annual income of 5 million yen, about $30,864. The trade-off: loan-to-value tops out around 80% of the property's price or appraised value, whichever is lower, not the 100% Tier 1 can reach. There's a workaround at the major banks too. If your spouse is a Japanese citizen or permanent resident, they can act as guarantor, and some of those products open up even without your own permanent residency. Tier 3 is the hardest: non-residents, meaning people who don't live in Japan at all. If you're buying purely as an overseas investor, a standard Japanese residential mortgage generally isn't available to you. A small number of specialized lenders will still finance non-residents, but typically capped around 60% loan-to-value, well below what a resident could get on the identical unit. Run all 3 tiers against the same Minato Ward investment condo, priced at 36,870,000 yen, and the required down payment tells the real story. Permanent resident, 0 yen down. Non-resident buyer, 14,748,000 yen down, about $91,037. Same condo, same price tag, a $91,037 gap in cash you need on day 1. Rates follow the same pattern. The number on the sticker isn't the number everyone actually pays. Residents with a strong profile can access variable rates as low as 0.3%, up to about 1.4%, depending on the bank and loan term. For buyers who want a fixed rate for the life of the loan, the government-backed Flat 35 program runs roughly 1.5% to 2.5% as of 2026. But Flat 35 comes with a catch that rules out Tier 3 entirely. It generally requires the borrower to actually live in the property as their primary residence. A non-resident buying from abroad simply isn't eligible, no matter how strong their income looks on paper. Non-permanent foreign residents using a Prestia-style product typically pay 0.8% to 1.4%, a real premium over the best resident rates, even before the lower loan-to-value ceiling. Stack the tiers side by side, and the pattern is consistent across every variable. The less established your residency status, the smaller the loan, and the higher the rate on what you do borrow. This isn't arbitrary. Banks are pricing risk they can't easily verify: income earned and taxed overseas, employment stability abroad, and, for true non-residents, a borrower with no local assets a Japanese court can easily act on if the loan goes bad. There's also a data problem underneath all of this: your credit history from your home country doesn't transfer to Japan. A perfect credit score overseas means almost nothing to a Japanese underwriter, who has no local record to check it against. Currency adds another layer. If your income is earned in dollars, euros, or any currency other than yen, the bank is also underwriting exchange rate risk over what could be a 20 or 30-year loan term, One more reason non-income borrowers get a smaller loan and a higher rate. And in 2026, the paperwork side got heavier too, specifically for non-resident buyers. Starting April 1, 2026, non-residents purchasing Japanese real estate must file a Bank of Japan foreign exchange report within 20 days of the transaction, under Japan's Foreign Exchange and Foreign Trade Act. This isn't a tax or a fee, it's a disclosure requirement. The government wants better visibility into how much overseas capital is flowing into Japanese property, as foreign buying activity has climbed sharply in recent years. It's a big part of why so many non-resident foreign buyers skip financing entirely and just pay cash. When your loan-to-value caps out low and your rate runs high, a full cash purchase often isn't just simpler, it's actually cheaper over the life of the deal. The catch with an all-cash strategy: it ties up a large amount of capital in one illiquid asset, and gives up the leverage that makes real estate returns attractive to begin with. If financing doesn't pencil out at any tier, there's a fourth path worth knowing about: Japanese REITs, traded on the Tokyo Stock Exchange. You get exposure to Japanese real estate with no residency test, no down payment gap, and no mortgage application at all, at the cost of direct ownership and control. Whichever tier you're in, expect the same paperwork ask: proof of income, tax returns from your home country, a detailed credit history, and, for non-residents especially, a much longer approval timeline than a domestic buyer would face. Most Japanese mortgages also require group credit life insurance, called danshin, which pays off the remaining loan if the borrower dies. Some insurers restrict this coverage by nationality or place of residence, which can quietly disqualify a borrower who otherwise cleared every income and visa hurdle. One more variable: the loan-to-value ceilings we've covered are typical for Tokyo and other major metros. Regional properties, especially older or rural homes, often get appraised lower relative to their asking price, which can shrink the effective loan size even further for the same borrower tier. Where a resident buyer might close in 4 to 6 weeks, non-resident financing can easily stretch past 3 months once translation, verification, and manual underwriting are factored in. If you're already a resident on a long-term visa with steady local or verifiable foreign income, financing through a Prestia-style lender usually makes sense. The rate premium is modest next to the leverage you gain. If you're a true non-resident buying primarily for investment, run the math on cash first. The lower rate you'd pay by avoiding financing altogether often beats the modest leverage a 60% loan-to-value deal gives you. Quick recap of the 3 tiers, on the identical condo we've used throughout this video. Permanent resident, up to 100% financing, 0 yen down. Non-PR resident, up to 80%, 7,374,000 yen down. Non-resident, around 60%, 14,748,000 yen down. We've also covered the hidden ongoing costs of owning property in Japan, and the full buy versus rent math for Tokyo, in earlier videos on this channel, worth watching alongside this one before you commit. That's how Japan actually finances foreign buyers in 2026. Subscribe for more data-driven breakdowns of real estate and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.